Institutional market correlation is something important to take in consideration when it comes to trading. Now, the reason why it's important is because you want to know what it is that you're trading. You want to know if you're trading a overall big accumulation, a big distribution, or a small accumulation or small distribution. And something that many of us tend to do is we tend to go ahead and jump around from time frame to time frame. It's okay to an extent, but majority of the time you want to stick to a time frame that you are trading on. For example, if I'm seeing a move happening on the 1 hour time frame, let's say right here, I see how market went ahead and took out liquidity, went ahead and created this move right here, and then we went ahead and created another move over here. Now, before we create that other move over there, we can see how market had created liquidity down below. This is all happening on the 1 hour. Since this is all happening on the 1 hour, I'm going to take in consideration major key points from the 1 hour before going on to smaller time frames. So major key points can be areas of imbalance, points of interest, accumulation of price, so on and so on, and mainly order flow. So in this section right here, we can see how market went ahead and had a nice spike to the downside, and then we had order flow being created. So we had a nice order flow being created right here. Now that we were able to identify that order flow was created right there, we know that market will potentially continue on moving down. All we have to wait for is going to be a overall confirmation. Now, what's another confirmation that I'm seeing right here? One of the other confirmations that I'm seeing right here is that there was imbalance. Look at this whole huge imbalance zone. This right here, guys, is sexy. All right, so we can see right here, we have imbalance and imbalance. This whole section of imbalance. What ends up happening is that market goes ahead and fulfills the area of imbalance. We can see how market keeps going up, fulfilling, until finally it goes ahead and fulfills this area of imbalance. Until then, when market goes ahead and fulfills a major key point that you're looking at, for example, if we're looking on the 1 hour time frame, then once it has done that, now you can go ahead and look at potential correlations on the smaller time frame, which is either going to be on the 5 or 15-minute time frame, depending on what time frame you're more comfortable with. But don't be switching around from time frame to time frame looking for a overall accumulation, then another accumulation. You first got to find and identify the accumulation or distribution. In this case, we can see a nice distribution happening. We can see how market comes up into a point of interest, fulfilling imbalance zone, and also what's another correlation that we have right here? We have a nice discount coming into a 78.6 level, one of my favorite levels that I like to take in consideration. Once market has reached that area, now I can go into the 15-minute time frame. Now I can go back into that section that I was looking at previously, and I can start identifying potential movements in the market. So what are some of the movements that we can be looking into? Now we can be looking into potential correlations such as the 5-minute, the 15-minute for distributions and continuations to the downside. Now we can see if I was to be trading at a certain time, for example, the New York session, then I would not have been able to enter on this trade. However, the following day, I would have been able to have a nice entry, as we can see how market went ahead and came into the 50% of this imbalance. We can see very nicely, comes and taps around the 50%, and that would have been a nice entry. This is when you start correlating your time frames, okay? Until then, you have to stick to the time frame that you're looking at. If you're looking at the 1 hour time frame, looking for accumulation, let it all play out until the point where you would have potentially looked for the entry. When you start seeing where you would potentially have that entry, then you can go to the 15-minute time frame or the 5-minute time frame, whatever time frame you feel more comfortable with for potential entries. And at that moment, that is when you can go ahead and correlate the bigger time frame to the smaller time frame for your entry. Given this, we can see how market went ahead and correlated very nicely, tapped into the 1 hour imbalance zone, and also we can see how there is a 15-minute imbalance zone. Coincidence? I don't know. So as we continue into the next day, because I personally would have not taken this trade because it's not the given time that I like to trade, I would have gone ahead and waited for the next following day, and we can see how market comes up, and then we have, you look at this, the exact same thing that happened previously. We have that liquidity, we have the imbalance, comes back and taps in. Fractions, guys, fractions. So with that being said, I hope you guys enjoyed this quick little lesson. As always, like, comment, subscribe. Let me know what you'd like to see next on the comments down below, and I'll see you guys next time. You guys have a great one. Bye-bye.